Have you ever wondered why some businesses go absolutely bankrupt right in the middle of their highest selling months? I mean, how is it mathematically possible to sell mountains of products, be busier than ever, and somehow still lose money? It seems totally counterintuitive, right? Well, today we're going to answer exactly that, and we're setting up the ultimate why behind the numbers. Welcome to this explainer on demystifying cost volume profit, or CVP analysis. Today, we are cracking the code on profitability. We're going to take what might seem like super dry accounting formulas and turn them into a dynamic, everyday business survival toolkit. All right, let's dive right into this. Here's our roadmap for today. First up, the core of CVP. Then, we're mastering contribution margin, finding your break-even point, planning for target profit, and finally wrapping up with the power of operating leverage. Okay, section 1, the core of CVP. Before we start calculating anything, we really need to lay the groundwork. To mathematically model the reality of a business, we have to make a few assumptions. We assume costs are strictly either fixed or variable, and that revenue and costs behave in a perfectly straight, linear line. We also assume our prices are constant and known. We're looking at a single product mix, and we're just completely ignoring outside factors like the time value of money or interest. Doing this strips away all the background noise and lets us focus purely on the operations. Moving right along to section 2, mastering contribution margin. Honestly, this is the absolute hero of our story today. So what exactly is a contribution margin? Simply put, it's your revenue minus your variable costs. Think of this as the exact slice of the pie from each individual sale that actually steps up to contribute to paying off your fixed cost debt. And once those fixed costs are totally covered, boom, that margin contributes directly to your operating profit. Now, we can measure this margin in 3 distinct ways. First, there's the total contribution margin, which is just your total revenue minus your total variable costs. Second is per unit, which is your unit selling price minus your unit variable cost. And third is as a percentage, where you divide that unit contribution margin by the unit selling price. To put that into perspective, let's say you sell a t-shirt for $10 and it costs $4 in materials to make. Your unit contribution margin is $6, giving you a percentage of 60%. Pretty straightforward, right? Picture a single dollar of revenue. The absolute second you earn it, it's instantly chopped into 2 distinct pieces. One piece pays for the cost to make that specific item, that's your variable cost. But the piece left over, that is your contribution margin. Every single dollar you earn in your business behaves this exact same way. All right, section 3, finding your break-even point. Let's put that margin to work. 0. That is the magic number right here. The break-even point is the exact moment where your operating profit equals exactly 0. There are no losses, but there are absolutely no gains either. You've basically just hit your baseline survival threshold. Now, if you want to know how to survive in terms of physical items, you calculate your break-even in units. Just divide your fixed costs by the unit contribution margin. If your rent is $6,000 and your unit margin is $6, you have to sell exactly 1,000 shirts just to break even. But if you want to know how much actual cash needs to hit the register, you calculate break-even in revenue. You divide those same fixed costs by the contribution margin percentage instead. Finding your survival point just depends on whether you want your answer in physical items sold or total dollars earned. On to section 4, planning for target profit. Because surviving is great, but we actually want to make some money. The target profit equation is beautifully simple. We just take that previous break-even formula and add our profit goal directly to the fixed costs on the top part of the fraction. So it becomes fixed costs plus target operating income, all divided by the contribution margin. We're basically treating our target profit like it's just another rock we have to push over the hill alongside our fixed costs. So if we want $3,000 in profit, we add that to our $6,000 in rent, divide by our $6 unit margin, and we know instantly we need to sell exactly 1,500 shirts. But wait, welcome to the real world, where we have to deal with the inevitable curveball of income taxes. To find out what you really need to sell, you have to work backward. Step 1, figure out your target net income. That is your desired after-tax take-home pay. Step 2, divide that net income by 1 minus your tax rate. This mathematically grosses your goal back up to account for the government's cut before you even plug it into our CVP equation. Now you know the true gross sales required to hit your final take-home goal. Finally, we arrive at section 5, the power of operating leverage. You see, CVP analysis isn't just some static math trick. It's a dynamic simulator called sensitivity analysis. It lets you play the what-if game. What if the selling price changes? What if volume shifts? What if our variable cost per unit goes up or our fixed costs jump? You can actually predict exactly what happens to your profit if a supplier suddenly raises costs, or if you decide to run a massive sale and drop your prices. And that leads us to operating leverage. By definition, this is the effect that fixed costs have on changes in operating income as changes occur in units sold. Think of it as a massive amplifier for your business. Relying heavily on fixed costs, like fancy expensive machinery or prime real estate, can make your profits completely explode when sales rise. But on the flip side, it can cause rapid, devastating losses when sales drop. We can measure this exact structural risk using the degree of operating leverage. This equals your contribution margin divided by your operating income. These are literally the two numbers from our previous steps, just stacking together to measure your risk. And notice something kind of amazing here. The only difference between the top of this fraction and the bottom is your fixed costs. This is exactly why traditional financial accounting can be a little misleading. It heavily mixes fixed and variable costs together under gross margin. But a contribution income statement splits costs entirely by how they behave, variable versus fixed. This format is what lets us actually see that operating leverage in action. It exposes the operational truth that traditional accounting often hides. Now, I know some of you might be thinking, but wait, I sell dozens of different items. Let me quickly reassure you, if a company sells more than one thing, the exact same CVP formulas work perfectly. All you do is pretend the products are sold in a constant bundle. You just calculate an average contribution margin for that specific bundle or your sales mix and plug it right back into the exact same math we just learned. So, based on all these building blocks we've put together today, I want to leave you with this. Are your fixed costs a dangerous weight dragging you down during a slow month, or are they the ultimate lever perfectly designed to multiply your profits? Take these tools, run the math on your own operation, and find out. Thanks so much for joining me today, and keep analyzing.